Hello, everybody. This is Sunko, the Korean bro. Today is 2023, July, August, October, September, uh, September 10th. Okay, let's go. Meta just unveiled a game-changing generative AI tool. Is the stock about to pop? Hmm. Hmm. Should Nvidia be worried about Microsoft's new artificial intelligence chip? It was reported Microsoft will be unveiling its in-house AI chip next month. The cloud giant and its subsidiary OpenAI are furiously looking for alternative to expensive Nvidia chips. How worried should Nvidia shareholders be? Microsoft may be announcing its own in-house design AI chip. What does that mean for Nvidia's future? 2023 has been the year of artificial intelligence when the technology's capabilities reach the tipping point of usefulness. No stock has benefited more from this inflection than Nvidia, whose graphics processing units and CUDA software ecosystems enable the parallel processing of massive data sets used to train cutting-edge AI models. However, with chip shortages abounding, Nvidia charging massive premiums for its GPUs, a slew of other companies are at work designing their own accelerators. Reports are the latest effort will come from cloud giant Nvidia customer Microsoft. But is the upcoming Microsoft AI chip something for Nvidia shareholders to worry about? Microsoft to unveil Athena. Hmm. A slew of other companies are at work designing their own accelerators, and reports our latest effort will come from a cloud giant Nvidia customer, Microsoft. It has been known for some time that Microsoft was working on its own AI chip, condemned Athena, after the Greek goddess of wisdom and warfare. Back in May, even before Nvidia reported blowout AI fueled earnings and guidance, Bloomberg reported Microsoft was not only working on its own AI accelerator, but also cooperating with Nvidia competitor Advanced Micro Devices on a competitive general purpose AI accelerator. The report even went so far as to say Microsoft was helping fund some of AMD's efforts. In June, AMD unveiled the MI300, its own answer to NVIDIA H100 AI chips. Last week, it was also reported that Microsoft's subsidiary OpenAI, the company behind ChatGPT, was contemplating developing its own AI chip either eternally or through an acquisition. In recent days, the information reported Microsoft may unveil the Athena AI chip next month. OpenAI may also try out Microsoft's new Athena accelerators in addition to its own potential efforts there. The move is not surprising given that OpenAI is investing furiously to lead the artificial intelligence gold rush. But OpenAI's endeavor is massively expensive. According to Bernstein analyst Stacy Rizin, if OpenAI's ChatGPT grew to just 1/10 the size of Google search, it would need to buy $48 billion of GPUs right away and then at least $60 million annually on an ongoing basis. Thus, it's no surprise Microsoft and OpenAI are working furiously to seek alternatives. An eternal chip-making venture would be the most cost-saving. But even strengthening an NVIDIA competitor such as AMD would also limit the exorbitant premiums NVIDIA currently charges. It's actually surprising Microsoft is this late to the game on the chip-making front. Google parent Alphabet has been making its own in-house accelerators called Tensor Processing Units since 2016, and Amazon came out with its Inferentia AI chip in 2019, with its Turanium counterpart coming later in 2021. Perhaps Microsoft's historical focus on software, after all, its name is Microsoft, um, made the cloud giant hesitant to wade into a costly chip-making effort outside its circle of competence, but certainly seeing the necessity now. Is Athena a threat to NVIDIA? NVIDIA is certainly in pole position and is likely to dominate AI computing for the immediate future. Uh, Moreover, the AI chip market is forecast to grow by leaps and bounds. Some forecast a 50% annualized growth rate between now and 2027, which is a massive amount for any product to grow in 5 short years. That's why Nvidia's stock has exploded higher this year. And Nvidia's stock has pulled back in recent months as investors debate how the company's earnings may look a few years out. If you are an investor in Nvidia or thinking about becoming one, you need to plot out NVIDIA's growth and profits for the next several years. But in light of the competitive onslaught currently underway, you probably shouldn't use its current 85 to 90% estimated market share in AI chips as your baseline. Nor should you perhaps extrapolate further margin gains a few years out as more competition enters the fray. So that is why NVIDIA investors should be cautious, but it's also possible that even with a somewhat lower market share, NVIDIA will still see outsized growth due to the explosion of AI computing, even enough to justify its current price. It's also very unclear if in-house design AI chip from a cloud giant AMD or others will make significant inroads. In 5 years, NVIDIA Cloud went up with 80% share of the EA market or 40% for a continued investment in the chip giant, you should probably form some sort of thesis as to how much of the EA market you think it will be able to ultimately retain. The future scenario and not merely the next quarter will make all the difference for Nvidia's intrinsic value today. Hmm. Okay, let's go with this one. Trade desk. Oh no, not trade desk. Hmm. A list of extra owner stacks wouldn't be complete without Tesla. The leading brand in electric vehicles said it delivered 435,059 EVs in the third quarter. It's come a long way from the sub 10,000 quarterly deliveries in 2013. Its growth has powered Tesla's market value from less than $15 billion to $826 billion. Despite Tesla's enormous growth at just getting started, EVs still make up only a tiny fraction of the total vehicles on the road. However, the advantages for Tesla is that it has a growing number of EVs collecting data to feed its neural training, which could make its self-driving car software the most advanced driving computer in the industry. Tesla said it plans to spend $1 billion on its Dojo training computer through 2024. However, Tesla isn't being selfish with its technology. CEO Elon Musk said the company wants to license its software to other car manufacturers, and one Wall Street analyst has already crunched the numbers on what this could mean for Tesla. By 2040, Tesla's network service business could generate $335 billion in revenue, up from an estimated $135 billion in 2030. According to Morgan Stanley analyst Adam Jonas, this business could produce 60% of the company's core profits in the next few decades. Jonas believes stock could hit $400 within the next 18 months, 54% above the current share price. Other investors seem to agree. The stock has surged 110% so far this year as Tesla reports strong growth in an otherwise lackluster car market. Investors who see Tesla as more uh, um, yes, Uni. Um, I was talking about the company named fan. I'm a huge fan of you too. I was talking about the company named Tesla. As you may well know, Tesla is known for EV, right? Yes. Okay. Um, Tesla, as you may well know, Tesla is known for EV, electronic vehicle, right? Hmm. And the article that I was reading is about how far they have become. Because a few years ago, they produced like 10,000, um, and they delivered like 10,000 vehicles, but now they delivered like 435,059 EVs in the third quarter. So they've come a pretty long way, right? And author of this article keep strongly says that its potential is really huge, considering that like all the things. I mean, like they could collect a lot of data with EVs they produce, and the EVs produce could be out there and collect a lot of info, which could result in neural networks. Neural networks could give them another info again. You know, it's like a vicious, not vicious cycle. It's like a good cycle, right? Mm. Uh, and here he says by 2040, Tesla's network service business could generate $335 billion in revenue, off from an estimated $135 billion in 2030. According to Morgan Stanley analyst Adam Jonas, this business could produce 60% of the company's core profits in the next few decades. Jonas believes the stock could hit $400 within the next 18 months, 54% above the current share price. Other investors seem to agree. The stock has surged 110% so far this year as Tesla reports strong growth in an otherwise lackluster car market. Investors who see Tesla as more than EVs could be in for the ride of a lifetime. So, my portfolio consists of um, two sectors in total. One would be ETFs that I heavily invested into, which are S&P 500 and Nasdaq, and the others are for all individual stocks. And Tesla is one of them. So that's why I read an article about it. And let's see what other articles we have. Mm, Booking Holdings. Hmm. Cloudflare. Okay, let's read this one again. Previous article was about Tesla, and the one that I'm going to read just right now is about Tesla as well. Let's see what that signifies. One stock split AI growth stacked by now before it soars 860%. According to Kathy Wood's Art Invest, electric vehicle market leader Tesla is also one of the most profitable automakers in the world. The company has a considerable data advantage in the nascent autonomous vehicle market. Tesla plans to mass produce a robotaxi next year, entering a market that Art Invest values at $9 trillion by 2030. Popular fund manager Kathy Wood sees substantial upside for Tesla shareholders in the coming years. Tesla underwent a 5-for-1 stock split in August 2020 and a 3-for-1 stock split in August 2022, a testament to its tremendous share price appreciation in a very short time. The stock price skyrocketed 1,230% over the last 5 years, a rate of return that would have turned $10,000 into $132,000. That's pretty much. Stock splits themselves have little impact on the business, but the reason behind the split for substantial and sustained share price appreciation can be an important signal for investors, as it often hints at solid fundamentals and strong growth prospects. Okay, there is point here. So stock split itself uh, has barely any meaning, but then what it means is that it's substantial and sustained share price appreciation is important. Uh, it's an important signal for investors as it often hints solid fundamentals and strong growth prospects. Okay. Tesla bears will undoubtedly argue the company has neither, but Kathy Wood sees tremendous upside for Tesla. Her innovation-focused asset management firm Art Invest published a valuation model earlier this year that posits a bull case price target of $2,500 per share by 2027. That implies roughly 860% upside for Tesla shareholders in a little more than 4 years. Is that realistic? Hmm. The electrical vehicle company Tesla accounted for 20% of global battery electric vehicle sales year through July, putting it 5 percentage points ahead of the next competitor. But Tesla isn't only the market leader in BEV sales, but also one of the most profitable car companies of any kind, reported the highest operating margin among volume automakers last year. Some CEO Elon Musk attributes to spur manufacturing technology. Investors can expect similar profitability in the future for two reasons. First, Tesla produces battery packs, the most expensive part of an electric car, at a lower cost per kilowatt hour than any other automaker, according to Care Energy Research Advisors. Analysts expect the advantage to last throughout the decade. Second, Tesla plans to implement a new manufacturing process at Gigafactory Mexico. They could cut production costs in half while reducing its factory footprint by 40%. Third, CEO Elon Musk says gross profit margin could approach 70% as full self-driving software and robotaxi services become major parts of the business. That would be a stunning increase from the 21.5% gross profit margin the company earned over the past year. Tesla is predominantly an electric car maker today, but will pivot toward artificial intelligence software and services in the future. And its FSD platform will be the fulcrum of that transition. Tesla plans to monetize its autonomous driving technology in three ways. First, it will sell FSD subscription to drivers. Second, it will license FSD software to other automakers. Third, it will use its FSD software to power a fleet of robotaxis. Fulcrum of that transition. Fulcrum, okay. Building on that, Tesla is arguably a front runner in the autonomous driving space. With millions of FSD-enabled vehicles on the road, the company sources data on scale that easily eclipses that of every other automaker. Indeed, Kathy Wood says Tesla has more autonomous driving data than any would-be competitor combined. The advantage hints at superior autonomous driving technology simply because training data volume is directly correlated with our AI model efficacy. Here's the upshot. Tesla has a strong foothold in the electric car market, which is forecast to grow at 23% annually to reach $1.7 trillion by 2032. Tesla also has a strong foothold in the autonomous vehicle market, which is projected to grow at 35% annually to reach $2.4 trillion by 2032. Finally, Tesla plans to mass produce a robotaxi in 2024, entering a market that Art Invest values at $9 trillion by 2030. Art Invest published a valuation model for Tesla earlier this year that uses a Monte Carlo simulation to consider a million different scenarios through 2027 to illustrate the range of possible outcomes or condense those scenarios into a bear case, a base case, and a bull case. The bear case price Tesla stock at 1,400 per share in 2027, implying a 438% upside. The base case prices start at $2,000 per share in 2027, implying a 669% upside. And the bull case prices start at $2,500 per share in 2027, implying an 860% upside. ARK assumes Tesla will earn roughly $769 billion in revenue in 2027, with electric vehicles accounting for 46%, robotaxi services accounting for 34%, and other sources accounting for 20% of that total. It implies an annual revenue growth of 60% through 2027. Is Tesla worth buying? I'll cut to the chase. I admire Kathy Wood and Art Invest for providing open source valuation models that offer so much detail, but the assumptions made by all three scenarios seem outlandish. I highly doubt Tesla shareholders will see returns between 438 and 860% by 2027. To say I do believe Tesla can successfully pivot into FSD software and robotaxi services, disrupting the transportation and mobility industries in the process, with shares trading at 9 times sales. A discounted 5-year average of 11.2 times sales. I think patient investors with an appetite for risk can buy a small position in this growth stock today. So, okay, I get it. So, see, the author of this article really appreciates what Kathy Wood has analyzed. Kathy Wood came up with 3 cases: bull case, base case, the bull case, and all 3 cases result in high profit. And author of this article doubts that this will ever happen. Of course, he believes in the growth of this company, but then at the same time, he highly doubts uh, Tesla shareholders will ever have returns between 438% by 2027. That's something uh, uh, well, it's out of topic at this point because it's his opinion. So, mm. Okay, let's see what else we have. I'm gonna read one more article and then I'll talk about my opinion and then I'll put an end to YouTube video tonight. Okay. So the next one that I'm going to talk about is uh Alphabet. Okay, Alphabet. Okay, let's go. The billionaire hedge fund CEO thinks this company will be a dominant player in one of the biggest investing opportunities in our lifetime. Okay, let's see. Bill Ackman ranks as one of the wealthiest and most famous hedge fund operators on the planet. His firm, Pershing Square Capital Management, has scored numerous big wins since he founded it in 2004. Hmm. Yes, while some hedge funds own a large number of stocks, Ackman prefers to focus on a handful of carefully chosen holdings. Several of them have delivered impressive returns in recent years, but which of them would be the best pick for retail investors to consider? Here is one Ackman stock most likely to turn $200,000 into $1 million over the next 10 years, in his opinion. Okay, Ackman's second biggest investment, Alphabet, a new position Alphabet in the first quarter of 2023. At the end of quarter first, Pershing Square stake in the tech giant stood at a little under $1.1 million. They ranked Alphabet dead least among hedge fund holdings. By the end of the second quarter, the stock had moved up in the ranking somewhat. Pershing Square owned nearly $1.4 billion worth of Alphabet shares, enough to make it the fund's fourth largest position. However, Altman revealed in an interview at CNBC's Delivering Alpha conference on September 28 that Alphabet is now his second biggest investment. He stated that his hedge fund continued to buy shares with its price in the $120 range, not much lower than its current share price. Why does Altman like Alphabet so much? He told CNBC's Scott Wapner that he believes the company will be a dominant player in artificial intelligence for a very long time. How might Alphabet pull it off? Let's start with the company's biggest money maker, advertising. Between 2020 and 2022, advertising revenue from Google Search, YouTube, and other sources increased at a compound annual growth rate of close to 23.6%. Over 3 years between 2017 and 2019, the CAGR was 18.8%. If over the next 10 years, the business achieves a CAGR of 20%, a middle of the road result based on its history, Alphabet's advertising revenue would jump by more than 6 times. However, advertising isn't Alphabet's biggest growth driver these days. Google Cloud is. It's not hard to envision Google Cloud's revenue skyrocketing by 10 times over the next 10 years as rapid AI adoption fuels a huge rush to the cloud. Don't forget, Waymo currently Alphabet's self-driving car technology unit, doesn't contribute much to the company financially. They could change tremendously in the coming years, with the robotaxi market potentially poised to explode. Alphabet could have a few wild cards that work to its benefit as well. I'd put a possibly quantum computing breakthrough high on the list. The company has already achieved several key milestones in a promising area. What obstacles do they have? Several potential obstacles to prevent Alphabet from becoming a fast beggar over the next 10 years, though. An obvious one would be a prolonged economic downturn. Alphabet's advertising revenue growth would almost certainly taper off in this scenario, likely dragging the stock price down too. Some notably, including Bill Gates, predict that the advent of AI-powered personal digital assistant could disrupt Alphabet's search business. Gates stated in May that the right kind of AI assistant could mean that people will never go to search site again. Even if Alphabet avoids an outcome that's quite that dire, it could face stiff competition in its highest growth business. Google Cloud begin losing market share to other cloud services run by tech giants. Waymo could be left in the dust by other self-driving car companies. Okay, uh, this hash fund guy thinks that Alphabet has so much potential, and he's saying it could grow by 5 times, which is plausible in this case because Google currently earns a lot of money from mm, what is it, advertising, and at the same time, it's not the only sector they focus on. They have got a lot of sectors like what else they have, like, you know, quantum computing, and they're doing pretty well. So anyway, this is it for today. Uni, are you there? And I'm gonna see you tomorrow. Okay, Uni. Bye bye. Bye bye. Bye bye, Uni. Bye bye. Oh yeah. Yeah.